All right, and welcome everyone. Recording is started. Welcome to Forex Basics and welcome to NurreFX, an overview of the FX market. These tutorials are designed to get you up to speed on, as we start off on the basics of Forex trading. So if you're a novice or beginner FX trader and you don't really know a whole lot about the market, that's exactly what these basic tutorials are for. My name is Steve Nurre with NurreFX. And we're going to go ahead and get started to introduce you to this fascinating trading market, if you will. So if you're just now starting off into Forex trading, you're probably wondering what is the foreign exchange market? What is currency trading? You've probably heard that it is the largest market in the world. However, to get you up to speed on the basics, I feel it's necessary to go through basically the theory of what foreign exchange is. So what is the foreign exchange? The foreign exchange is a simultaneous exchange of one country's currency for another. If you've ever traveled, if you've ever gone to another country, and let's say you live here in the US and you've gone somewhere like Europe, if you've taken US dollars with you and you've gone to one of those little currency exchange desks at the airport when you land in Paris or wherever you're going, you've probably traded foreign exchange before, because the second that you exchange your dollars into euros, you've actually traded the Forex market. You've actually done it without leverage, if you will, but that is considered a foreign exchange transaction. That is considered something that actually creates volume in the foreign exchange markets when you do complete that transaction. But in order to give you kind of a better understanding of how the market works, we're going to go through a quick example of a typical foreign exchange trade. Now, when I was a boy, I had posters of Lamborghinis all across my wall. Like a lot of kids, you always dreamed of one day owning a Lamborghini. So let's say I live here in the US and I have a lot more money than I actually have, and I wanted to go out and purchase a Lamborghini. But let's say I didn't trust the local dealership here in the United States, and I wanted to import this Lamborghini directly from the horse's mouth, directly from the retailer over in Italy, where they're manufactured. So instead of coming from the dealership, I'll contact the retailer over in Italy and I'll get a quote on this Lamborghini. Now pay close attention, because this is an actual typical foreign exchange transaction that creates a large amount of the volume that you see in the foreign exchange markets. So I want to import a Lamborghini from Italy. That's the basics of foreign exchange. And when I call the retailer over in Italy, they quote me, and now this is pretty low. This would probably get me one that's used over there. But let's say I want to get it straight off the manufacturing floor. I want them to straight off the factory floor. I want them to put it on a boat. I want it shipped over to the United States and delivered to my house. And so I call the retailer in Italy, and I say, how much is this going to cost me? The Italian retailer says, okay, we can do this entire transaction for you. It's going to cost you 200,000 euros, because what do they spend in Italy? They spend euros. But what is going to be the actual cost to me? Because I live here in the United States, and so I use US dollars. Well, for this transaction, me as the US consumer, I'm going to have to give my bank a call, because I'm going to have to exchange those US dollars and into euros so I can pay for the Lamborghini with the Italian retailer. So my US dollar, via an exchange rate, has to be exchanged over into euros. So this exchange rate right there in the middle, that's going to tell me how much it's actually going to cost me in US dollars. So when I call up my bank and I say, hey, I need to wire 200,000 euros to Italy. And let's just assume that this includes all the fees and everything. It's all 200,000 is the total amount that I need to exchange. Well, the bank is going to look at something like this. It's going to look at the current exchange rate when I call to wire the funds over, and here's the euro US dollar exchange rate. So my bank is going to tell me, okay, the exchange rate, we'll look at that asking price. That price there on the left is 1.09700. So to do this transaction, the retail price is 200,000 euros. The exchange rate when I wire the funds over, when my bank exchanges the money, the US dollars into euros, is 1.0970. So 200,000 times 1.0970 comes to 219,400. So $219,400 is the cost for me to do this transaction. My bank account gets debited $219,400. It gets wired over to the Italian retailer. It gets exchanged into 200,000 euros. They receive the money. They take the Lamborghini off the factory floor. They put it on a boat. They ship it to my house. The guy in the truck delivers it to my driveway. He hands me the keys. He hands me the title. And my question that I always ask my students is this transaction done? And the answer is yes. This transaction is finished. This is a typical foreign exchange transaction. I actually exchanged money into euros and paid for a product, and that product got shipped to me, and I took delivery. Now, most of you are coming into this market because you want to buy and sell currencies, and you're trying to take advantage of the exchange rate as it fluctuates up and down to open and close positions and profit. But the fascinating thing about the Forex market, unlike the stock market and unlike options and futures, is that a large percentage of transactions that are done in foreign exchange transactions are done without a profit motive in mind. Think about it yourself. Do these types of transactions happen every day? If I'm a Lamborghini dealership and I'm having to create create inventory, and I'm having to import Lamborghinis into the U.S., those types of transactions are happening every day from business to business. That's a fascinating part of Forex trading with all the volume that flows through it, because you can't say the same thing about the stock market. You can't say that a vast majority of transactions that run through the stock market are done without a profit motive in mind. It may seem like that is something can create some randomness in the market, but it actually can also create quite a bit of predictability in the market. Now, on this same transaction, what this would look like, and remember, I exchanged dollars into 200,000 euros. If I was wanting to do this transaction on an actual Forex platform, and here, let me pull up a Forex platform for you. And remember, we actually exchanged US dollars into 200,000 euros. Let me go in here. And here's the Euro US dollar pair. You can see the exchange rate's actually moving up. We'll be going through some charting here in just a little bit. But if I wanted to do this same transaction, I'm going to right click here and I'm going to go to a new order. And I'm just making sure that this is a demo account. And I had done 200,000 euros. So I'm going to put in 2 lots on this as far as volume. Now you can see the exchange rate here, just like we saw. This is quoting me the asking price of 1.100405 right now. If I click on buy on this transaction, it's going to exchange dollars into 200,000 euros at a rate of $1.1005 per euro. I click on buy by market. That order is put in. And if you look down into my positions, you can see that I've now taken control of the Euro US dollar pair. I've exchanged dollars into euros, and I now control 200,000 euros via that exchange rate. The only difference here being the fact that in my transaction that I just showed you on my screen, it cost me, what, 219,000 some dollars to do that transaction. In this case, when you look at this margin number right down in here of $4,400, that is what we call leverage. I put up, instead of putting up 200 some thousand dollars to control 200,000 euros, I've only put up $4,400, but I'm still controlling 200,000 euros. I'm still holding 200,000 euros via that exchange rate. Now, as I stated before, this transaction here was done without leverage. Now let's just say, what would a closing of a foreign exchange transaction look like? Let's say I did want to profit. How would we profit off the exchange rate in Forex? Well, let's go through another scenario here. Let's say I want to return it. Let's say it gets delivered to me and there's a scratch on it, or I don't like it, and I call it, and I'm really mad as a consumer, and I call up the Italian manufacturer and I say, hey, look, this has some dents in it. You know, you were responsible for the shipping. I didn't take ownership until it was delivered to me. So I want to return this Lamborghini. This is hypothetical, remember. Okay. So I want my refund, and the Italian manufacturer says, yes, we'll refund you 200,000 euros. Okay. So then I look at the euro-US dollar exchange rate, and it's now 1.1070, which means the dollar has gotten weaker versus the euro. The euro-dollar exchange rate has gone up. First, I would ask you, is this a good or a bad thing to me? If they're going to wire me back those 200,000 euros into my bank account, remember, it has to be exchanged back into dollars. Would this exchange rate going up, which means the dollar has gotten weaker? Would that be a good thing or a bad thing? Actually, for me, that would be a good thing, because they're wiring euros back into my account and exchanging them into dollars. So as I did, I had exchanged these dollars into euros at 1.0970. Now I'm getting them exchanged back to me at 1.1070 dollars per euros. So when they wire the money back to me, I received $221,400 back into my account. That's going to be by refund. So that means I made $2,000 off the exchange rate, from $219,400 to $221,400. I made $2,000 off the exchange rate by returning the car to the Italian manufacturer. The Italian manufacturer didn't really lose on that, let's say, except for the shipping costs and whatnot. We're just sticking with just the theory of the exchange rate. But that's really how the foreign exchange market works. You're still wanting to buy low and sell high. In this case, I would have bought euros at 1.0970. I would have turned around and sold them to exchange them back into dollars at 1.1070, and that would be a typical foreign exchange transaction. For example, again, if I go back to my trading screen, and you see my trade right down in here, I exchanged dollars into euros at 1.10057. The current price it's up, let's say, 1 pip on here. You can see I'm up like $44. If I close out this transaction, I've just done the same thing as I did in that example. But instead of dealing with physical money being wired back and forth, we're dealing on a foreign exchange platform. And I close out that position. And in this case, I made $20 on that transaction that I just put in. But it was controlling the same amount, this 200,000 euros. And the difference on that platform is the fact that I didn't have to put up this huge amount of money in dollars to do it, because we are utilizing leverage. Little history of the foreign exchange market, because students that come through my class usually know that I like to look at the history of everything. I was a history major in college. The Bretton Woods Accord, which was, I believe, in June of 1944, I think it was almost a full year before the end of World War II, is actually a big part of the history of foreign exchange. A group of countries gathered together in Bretton Woods, New Hampshire, I believe, and they were trying to come up with a way to stabilize the global economy leading into the end of World War II. And to do this, the decision was made that these countries, in order to stabilize exchange rates, would peg or fix their country's currency's exchange rates to the value of the US dollar. And the value of the US dollar at that time was fixed or convertible into gold, as far as the US dollar was pegged to gold. So they did this in order to stabilize exchange rates and to create, actually also to stimulate global trade, if you will. What also came out of this Bretton Woods Accord was also the International Monetary Fund, and one of their initial responsibilities for the International Monetary Fund was to oversee this fixed exchange rate policy between countries. So this is where kind of the history starts. If you ever wonder why you ever see Bretton Woods Accord in the history of the Forex, it's because that's where all these currencies got fixed, their values to the US dollar. Now, the Forex as we know it actually came about in approximately 1971 with what we call the Nixon shock. In 1971, the Vietnam War had created a huge amount of deficit spending, So what happened was there was this huge deficit spending creates huge supplies of US dollars out there into the market. So what Nixon did with all this supply, and remember the US dollar was fixed or convertible into gold or pegged to gold, in order to avoid a run on Fort Knox, if you will, because of this fixed exchange rate policy, President Nixon revoked the gold standard, meaning the US dollar was no longer fixed or convertible into gold or pegged to gold. It was now, or backed by gold, would probably be a better way to phrase that. The US dollar was now going to be just backed by the good faith of the US government. And don't laugh. So what happened is now that the US dollar was not backed by gold and it was only backed by the good faith of the US government, instead of all these currencies being fixed to one another as far as exchange rates, it created what we call a free floating currency market, to where now, instead of this fixed or pegged type of exchange rate policy, all these exchange rates kind of floated out on their own, to where now their exchange rates would fluctuate up and down based on supply and demand from one country to another. And that's where the Forex as we know it came about. The retail Forex market, as you want to trade right now, really came about in 2000 with the Commodity Modernization Act. Up until 2000, yes, you could trade Forex from a retail standpoint, but the Commodity Modernization Act of 2000 is what really created large amounts of leverage to be added to the market, toward just your average US, trader sitting at their home in front of their computer could start downloading software and going online into different trading platforms and utilizing leverage to buy and sell currencies. That's really this market is still actually very young when you think about it, when it comes to the history of it versus other markets. So even here in 2016, I think that you could still look at yourself as as kind of an early adopter of the market when you compare it to, let's say, the stock market. The Forex marketplace, there's several benefits of wanting to trade the Forex market. The hours are extremely flexible to most traders. The liquidity involved in the market is second to none. The leverage involved in the market allows you to put up a small amount of money to control a large amount of money. And the currencies that we trade is actually very important, because there is a misconception out there that in order to be a Forex trader, you have to look at thousands of out of all the countries in the world with different currencies, it's like the stock market, to where you have to look at all these different investment instruments, and that's just not the case. So let's start off with the hours. It is a 24-hour market. Does not mean that it does not open and close, but it only opens once a week and closes once a week. It opens at 5 p.m. I put these in Eastern time because I am in the Eastern time zone here in the U.S. It opens at 5 p.m. Eastern time on Sundays and closes at 5 p.m. Eastern time on Fridays through most Forex brokers. These times can vary a small amount depending on which country you live in and which broker you use. But between those hours from Sunday to Friday, it trades continuously 24 hours a day. Now, what this creates for you as a trader is, if you're, let's say, a stock trader here in the U.S., you're probably used to only being able to, let's say you want to actively trade the stock market. Well, that opens at 9:30 a.m. Eastern. It closes at 4 p.m. Eastern time. And if you really want to actively trade that market, you are kind of, most people are at their jobs or whatnot throughout those times. So, you have to kind of check it secretly at work or whatnot. In this market, no matter what your schedule is, you have quite a bit of flexibility as far as, if you want to trade the market when you get home from work, or in the middle of the night after the kids go to bed, or early in the morning before you go to work and check your trades, the market is continuously trading. So that does give you quite a bit of flexibility. One thing we'll be talking about as we go through is just how the market works. 5 p.m. Eastern time, because these are when banks open and close. And the first, as far as the rotation around the globe, the first banks and markets to open when it's let's say when it's Sunday at 5 p.m. here, it's actually like Monday morning at 8 a.m. here over in New Zealand. So 5 p.m. Eastern time on Sundays, the reason why that's the opening time is that's when Australia, New Zealand, and Japan, that's like the Pacific Rim, that's when all those banks and markets are opening. It's Monday morning over there. And then that's what we call the Austrasian session, or some people might call it the Sydney session. I usually call it Austrasian, Australia and Asia opening up. The second markets to open up around the globe, we call it 3 a.m., which is what we call the London session. That's when you get Europe and London starting to roll. That's when those banks start to open. And then the last markets, the reason why the market closes at 5 p.m. Eastern time on Fridays, the last markets to open are the U.S. and Canadian markets, and to an extent the South American and Latin American markets, the last markets to open across the globe. These session-to-sessions, as each individual region of the globe opens and closes, different currencies come into focus, in and out of focus during those times. And it is one of the things that we will be discussing in our NurreFX classes in future sessions. As far as the market size, over $5.3 trillion trade on a daily basis. This number some people think that this number is like a U.S. stock market number, to where they calculate the volume each and every day in the Forex markets. Whenever you've heard this, as far as the volume in the Forex markets, the 5.3 trillion traded daily on an average basis, which does dwarf all the other markets. Stocks, futures, no more. You don't get as much liquidity in any market as you get in the Forex market. It's just an insane number that trades on an average daily basis. But unlike the stock market, where you can check like the NYSE volume every day, people often don't know this, but Forex volume is calculated every 3 years, not on a daily basis. Every 3 years, a place called the Bank of International Settlements actually comes out with a triennial survey of the foreign exchange markets, triennial report. And it's that every 3 years where they really get the most accurate depiction of what the daily average volume is in the Forex market. I believe the next one is due soon here in 2016, because this last number came out, I believe, in 2013. So what does that give you as far as a trader goes? It gives you a lot of efficiency. In the Forex market, nobody cares about you. And that sounds weird, but I think the bigger a market is, the more liquidity is involved. It gives you very efficient order entry in and out. There's always liquidity in the market. You're also a very small fish in a huge ocean of traders. And I think the more you go unnoticed as a retail trader, the better. So that efficiency in the market, that liquidity, is just a huge benefit to trading the Forex market. Leverage is also a huge, one of the reasons why most retail traders are switching over to Forex trading is because you do have a large amount of leverage available to you. Here in the U.S., our leverage is set at 50 to 1. That's standard leverage here in the U.S. However, depending on where you live around the world, that is put on us by the regulators here in the U.S., that maximum leverage of 50 to 1, based on major currency pairs. Leverage can range anywhere from 50 to 1 to 400 to 1, depending on what country you live in. Why is that important? Well, let's say you live somewhere where you have 100 to 1 leverage available to you. What that means to you is that if I came up to you and said, hey, give me $1,000 or 1,000 euros, and I will give you 100,000 euros to trade with and profit from. That sounds like a large amount of leverage, does it not? Or let's say you live here in the U.S. and I ask you, where we have 50 to 1 leverage, if I say, hey, give me $200 and I'll give you $10,000 to trade with. That sounds like a lot of leverage, and it is. So leverage is the ability to put up small amounts of money to control larger investments, to control a larger amount of money and profit off a larger amount of money. So that's a huge benefit of leverage, is the fact that you put up a small amount to control a large amount, to where you can make large amounts of money in a short period of time. There's also a flip side of that, by the way. You could also put up a small amount of money to control a large amount of money, to lose a large amount of money in a short period of time. So there are a huge amount of risk considerations to make in the Forex market. People often want to trade the market because of the reward potential in it. However, most people do not last that long because they cannot manage the risk considerations in this market. This market is not for everybody, and it's not for the faint of heart, and it's not for conservative investors. It's for people that want to be a little bit more aggressive in the way that they allocate their risk assets. The common currencies that are traded here in foreign exchange, believe it or not, the majority of the liquidity that goes through with most Forex brokers are done, and this is kind of the common 8 pairs that the majority of Forex traders will trade. The US dollar, the greenback or the buck, the euro, EUR, GBP, the Great British Pound, also known as the sterling or the cable, the Swiss franc, also known as the Swissy, Japanese yen, the New Zealand dollar, Australian dollar, Canadian dollar. Yeah, people will always ask me, are there other currencies that trade? Can I trade the Mexican peso? Can I trade the South African rand? Can I trade the Chinese yuan? Absolutely. Those are what we call free-floating currencies also. Because we do take advantage of the higher amounts of liquidity in this market, we generally are going to stick to the currencies that are the most actively traded. Not to say that you can't profit off of trading other currencies, such as the Mexican peso, but those more exotic type of currencies come with higher cost considerations, sometimes lower amounts of leverage to trade them. So just sticking with these, which we generally do in our class, gives us quite a bit of focus. Instead of looking at hundreds of thousands of different stocks that are out there and having to sift through the fundamentals and technicals, generally speaking, a currency trader could just pick 1 or 2 of these currencies to trade and become experts at those currencies and become a very well-rounded and successful trader in foreign exchange. So those are some basics of the foreign exchange, just an introduction into what foreign exchange is. As far as major pairs go, pairs including the US dollar are generally going to have the highest amount of liquidity. Meaning, whenever you hear the term major pairs, those are generally going to be pairs that include the US dollar, the euro dollar, the pound dollar. The reason why we call those major pairs is because the dollar is the largest currency held in reserves around the world. And it's generally the biggest driver of foreign exchange trading. We'll also use terms like cross pairs, and this will be a big part of class as we go through, which are pairs that exclude the US dollar, which we call dollar neutral pairs, and we'll explain why a little bit later. That would be your euro pound, your pound yen. So major pairs and cross pairs. Everything is done in pairs. You see, we're not trading like Microsoft or Intel or any individual stocks. We are trading actual, one country's currency versus another. So it's sometimes hard for people to distinguish in the Forex market because of the fact that you're not looking at one individual investment. You're looking at one country's currency versus another. Like the euro dollar. When you're trading the euro dollar, you're not looking at the fundamentals of a single stock. You're comparing the fundamentals of Europe to the fundamentals of the dollar. For example, on the recording of this tutorial, right now the euro is in the state of deflation. Their economy is not doing very well. They're in the midst of what we call QE, of printing billions of euros each month for asset purchases in the market. They have a negative deposit rate over in Europe. The US dollar, the Federal Reserve just got done raising interest rates, where the euro has negative interest rates right now. So you kind of look at those types of things when comparing, and based on that, you would think that fundamentally the euro's weak, dollar strong. It makes it pretty clear, because we're dealing on a macroeconomic level of which direction fundamentally a lot of these currencies should be going. So that's just some, now that we've gone through currency pairs, I just wanted to go through a little bit on some terminology that we'll be using as we go through class. As far as our next tutorial, I hope you've enjoyed this one. Our next tutorial, we're going to take it a little bit step further. Now that you've been introduced to the market, we're going to get through a little bit of the ins and outs of what it takes to trade it. You can't trade a market unless you have a good solid foundation in the basics of what the market means. Most people want to skip forward to just how to trade it, but we need to get the basics out of the way first. So the next tutorial will be on pairs, pips, and lot size. I want to thank you for watching, and I'll see you in the next tutorial. Thanks for coming in.